Hi everyone, this is Mark with Ease Investing. In this video, we're going to do a quick portfolio update and I'll go over my current positions that I have. By the end of this video, you'll have a solid grasp on the companies that I own stock shares with and the companies that I own stock options with. Let's get into this video. Before I get into these positions, I just want to explain real quick why I'm even doing these videos. The reason why I'm doing these videos is because having the knowledge of stock options has made a huge difference in my financial life. I've been able to make a lot more money with the knowledge that I have of stock options. When I first started to learn about stock options, they were very hard for me to understand and grasp because I had no idea that they even existed when I started to learn about them. Now that I understand them, I understand how truly easy they are and how much of a difference it makes in adding extra income in your life. So let's get over the stock shares that I own, and then we'll get into the stock options with my positions. So the stock shares that I own are Sofi, I own 100 shares, Nubank, I pretty much own 100 shares, and DLO, I currently own 2,000 shares. Sofi is a fintech bank, mainly here in the United States. NIO is also a fintech bank, but it's mainly outside of the United States. And DLO is in the semiconductor space. So with these companies, I own these shares. Now let's go ahead and scroll up into the options that I am currently doing, and I'll explain these options in a simple way so you understand how stock options can add extra income in your lives. So let's start off with the top one, and that is a Sofi $30 put that I have sold. So let's go ahead and click on that. We can see that I have sold a $30 Sofi put. What does that mean? What that means is I have agreed to buy Sofi for $30 a share if Sofi is trading below $30 by October 10th. Let me just repeat that real quick. I have made a promise that I will buy Sofi for $30 a share if Sofi is trading below $30 on October 10th. If Sofi is above the $30, then I do not purchase those shares. If Sofi is below the $30, then I have to purchase those shares for $30 a share. The reason why I make this promise is because I make money for making this promise. Let's scroll down and see how much money I made. For each contract, I made $1.95. One contract is 100 shares, so you times that number by 100 and that gets you $195. So for each contract, I got paid $195. I did 18 of these contracts. So $195 times 18, if we scroll down, is $3,510. So by selling these contracts, these 18 contracts on Sofi, I have made $3,510. I simply keep that $3,510 if Sofi is above $30 on October 10th. If Sofi is below $30, I still keep that $3,510, but I have to purchase the shares for $30 a share, 100 of them for each contract. And remember, I did 18 contracts. So that is selling a put or selling a cash secured put. Those are both the exact same thing. And that is how you make money by selling a put. So just off of this example, you now understand what selling a put is, how you make money selling a put, and the value of selling a put. Let's go back and go over my next position. So these are calls that I have sold, and that is on DLO. Remember, I have 2,000 shares of DLO. I am selling a call for $16.47. Let's go ahead and click on this and explain what it means. So when you sell a call, you get paid money for making a promise. The promise is if DLO is above $16.47 by October 10th, I have to sell my shares for $16.47. So if DLO is trading at $20, I'd have to sell my shares for $16.47. The reason why I made this promise is because I got paid money. How much money did I get paid? So I received 40 cents off of each contract. Remember, each contract's 100 shares, so I got paid $40 for each contract. $40 times 20, if we scroll down, is $800. I got paid $800 for selling this call on DLO. Let's go over the two scenarios. If DLO is trading below $16.47 on October 17th, I simply keep the $800 and I keep my shares. Let's go over what happens if DLO is trading above $16.47 by October 17th. If DLO is trading above $16.47 by October 17th, then what I have to do is sell all my shares for $16.47. I still keep the $800 and I keep the appreciation because the stock's trading at $15, so I keep the appreciation from $15 up to $16.47, plus the money that I got paid for selling this call. That is selling a call. You are making a promise, you are putting a cap on your stock, and you get paid money for putting that cap on your stock. If the price goes above that cap, you have to sell the stock for your cap. If the stock price stays below your cap, you simply keep the money and the contract expires on its expiration date, which in this case is October 17th. Let's go down to my next position. This is NVTS, which is in the semiconductor space. In this position, I have sold a put for $6. The stock's currently trading at $6.96. So remember, when you sell a put, you make a promise to buy the stock for whatever you sold the put for. So in this case, I made a promise that I'll buy the stock for $6 if it is trading below $6 on October 17th. Why did I make this promise? I made this promise because I got paid 30 cents per contract. Remember, each contract's 100 shares, so 30 times 100 is $30. And I sold 5 of these contracts. So let's scroll down to see what $30 times 5 is. I got paid $150 for making this contract. Remember, two things can happen. Either NVTS is below $6 a share. In that case, I would have to purchase the stock for $6, and I would have to purchase. So I'd have to purchase, I did 5 contracts, each contract is 100 shares, so that would be 500. So I'd have to purchase 500 shares for $6 per share if it was trading below $6 by October 17th. Now the other case is it's trading above $6 by October 17th. If that's the case, I simply keep the $150 and this contract expires, or my promise expires. Let's go to my next position. My next position is a call that I have sold on NU. Remember, if I scroll down, I owned 100 shares of NU. And so, since I owned 100 shares, I'm able to sell a call on this. And it's a $16 call. Let's click on it. We can see that it's currently trading at $16.25. The call that I sold was a $16 call. Let's go over what this means. So if you remember from the last example, I'm agreeing to sell my shares for $16 if the stock is above $16 by October 17th. If this is the case, I would sell my shares for $16. I did one contract's 100 shares, so I would sell my 100 shares for $16. Why did I make this promise? Because I got paid 53 cents for the one contract. One contract's 100 shares, so 53 cents times 100 is $53. If we scroll down, I got paid $53. So the two scenarios that exist is NU is trading above $16 by October 17th. If that's the case, I sell my shares for $16 and I keep the $53. Now, what if it's below $16 by October 17th? If it's below $16 by October 17th, then this promise or the contract expires and I simply keep the $53 and I keep my shares. So that's selling a call again. Let's go to the next position, which is NIO. NIO is an electric car company in China. I have sold a $6.50 put. Let's go ahead and click on it. Remember, when you sell a put, you are simply just making a promise that you'll purchase these shares for $6.50 by your expiration date, which is October 24th. For me making that promise, I got paid 30 cents per contract. 30 cents times 100 is $30, and I did 20 contracts. So $30 times 20, if we scroll down, is $600. So the only two scenarios that exist is NIO is trading below $6.50 by October 24th. If that's the case, I'll have to purchase the 20 contracts, which each is 100 shares, and I'll have to pay $6.50 for those shares. So if it's below that, I'm on the hook to buy these shares for $6.50, and I still keep the $600. Now, if it's trading above $6.50, which we can see it's currently trading at $7.40, so as long as it's above $6.50, then this promise expires on October 24th, and I simply just keep the $600. So that is selling a put explained again. And my last position I have on here are my new $15 calls. Now, instead of selling these, I bought these calls. So when you buy a call, you're betting that the stock price is going to go up. So if I click on this, I bought these $15 calls on NU, and my average cost was $4.70. Remember, each contract's 100 shares, and I did 40 contracts. So I bought a total of $4,700 plus $4,700 is what I purchased of those. And then I have a purchase, if I click on those, of $4,650 and $4,650. So those are my calls that I bought on new in this account. And we can see that I'm currently up on those. So when you buy a call, you are betting that the stock price is going to go up, and how you deal with your break even, or what you need the stock price to get to, is you simply scroll down and it tells you what it needs to get to. Now, my expiration date is December 17th, 2027, so I still have a few years until this call expires. So as long as the stock keeps going up by that date, I keep making money. Now the risk, let's go over the two scenarios. If Nubank is trading below $15 by December 17th, 2027, when I have bought a call, if it's below that, I lose all my money that I put into it. So we can see the market value of this is currently around $20,000. Let's say that this stock just tanks, or what I mean by tank is it goes down to, let's say it goes down to zero. I would lose all that money. Now, if the stock is trading above, so I paid, remember, $4.70 for these contracts, and I bought the $15 call, so you simply do $15 plus $4.70, which gives you $19.70. That's why your break even is $19.70. So those two numbers are important, because if Nubank or if new NIO is trading above $19.70 by December 17th, 2027, I simply make money. If it's below that, then I lose money. With all these options, you could close them out early. So this one I'm already profitable on by $920. If I wanted to, since I bought the call, I would simply just click trade and I would sell it for a profit. So even though the expiration date is December 17th, 2027, you could close it out early.